Hi, everyone. I'm Rick Bensignor. Today is Tuesday, May 26th, and welcome to the In the Know Trader Show. Well, once again, the markets or the stock market is thrusting higher. The S&P is up 50 points or so as we record, making a new high of the move. Um, we've gotten as high as 3,022 today. We'll talk about that a little bit as we get into the show. 10-year bond yields are at 70 basis points, up about 4.5 basis points today. Oil is up half a buck, and gold is getting hit, down $27.50 or so, down to 1708, as people feel less need to hedge up and have some type of security against the markets, with the market moving up as much as it has. But we'll get into a little bit of that as we go into the show and talk about markets, amongst other things. In fact, here, let's take a look at what we're going to do today. So we'll do our general markets overview, and we will specifically talk about the S&P, just as far as the type liftoff we're seeing and where that is in relation to what we want to be doing. We're going to do a trader education segment this week on taking losses, and we'll get to that. And then we'll talk about the transportation sector, a sector that is a piece of the industrial macro sector, but certainly moving quite a bit both to the downside during the height of coronavirus fears, and then snapping back quite a bit recently as things are starting to open up across the U.S. So this is a sector that we have interest in looking at, and so we will take a look at some of the top names in the transportation sector. First off, just in order to follow my work and become a subscriber and understand what we do here each week, not only in this podcast, but more so for subscribers of In the Know Trader, you go to inthenowtrader.com/sign-up-1.html, or just go to inthenowtrader.com and click on the sign up tab. And that'll give you all the information you need about becoming a subscriber to our weekly newsletter, which gives you key information about major asset classes. So we often look at a combination of stocks, bonds, gold, sometimes the dollar, with the key levels you need to be paying attention to. Plus, each week we put out a new ETF trading idea for you. These are intended as trades, not long-term investments. So we usually are holding them for weeks to months, not many months nor years. This is the report we put out each week is called the Tactical Trader Report, and it is meant to be short-term in nature. However, it is not for day traders and people who want 30 ideas each and every day. That's not what we do. We try to find something that has usually a counter trend type idea that has a decent chance of working over the next several weeks to months, and that's what you get each week. To contact me, write me emails at rick@inthenowtrader.com. We get tons of them a week from listeners, especially to this show, and sometimes you even give me ideas on what to talk about each week. So I thank you for that, and that's the best way to contact me. Let's start off by taking a look at our week-over-week sectors versus the S&P. The chart on the left-hand side was last week's chart, year-to-date. We now have that updated through, well, I guess it's probably updated through last Friday because we were closed yesterday. So the chart on the right is the most current, not including today's trading information. And there's only 3 of the 11 sectors that moved more than 1% in relative terms to how the S&P has done this year since last show. So we see that communication services is up 8.1%. Last week it was 566, so it had a very big surge the last 3 days of last week, and is the second best performer this year in the S&P. And then we notice a couple of red dotted sectors. Those are ones that have fallen more than 1% relative to how the S&P did in the last week. So we see that healthcare, still a good performer, the third best performer of the year, but kind of took a hit over the last week, falling from about 7.7% above the S&P's performance to now only about, looks like 5.94%. So it fell a good 1.5%, if not more. And then we also see that utilities, which is already an underperformer, became a bigger underperformer, down just over 4% this week compared to 3% last week. Otherwise, the remaining 8 sectors were fairly close in how they had done, so no major changes there. The big mover was the communication services sector. And they've pretty much been on fire this year. And other than technology, as I said, it is the second best performer. They had a great week. And what you generally want to do is try to find, when you're playing individual stocks, is you want to find which sectors are doing best, and then find kind of the good names within the sector. So think of it in terms of find the outperformers in general, the outperforming sectors. That's generally where you're going to get some good bang for your buck. And then find some of the best names within. And that's often a way people will look to come up with ideas of which names to play. So for instance, in technology, which we know has been the leading sector this year, was the leading sector last year too, you want to find the best outperformers in technology, and that's usually where the momentum and the money is going. And those could come off the first too in a market correction. That what's doing the best often can get hit the most in a corrective move in the opposite direction. But in general, if you're looking to invest for medium or longer term, you generally want to stay with the best performing sectors. And that's why we do this each week, is to kind of give you a sense of what's moving and kind of where to focus yourself as you play individual names. I don't play individual names for, or at least in our tactical trader report, we use ETFs. And I did that purposely when I created In the Know Trader, specifically to remove any of the single stock movement that can be detrimental. Yes, we give up some upside if we pick the right ones, but we also are protecting ourselves on the downside. And what I don't want you to do is, get stuck in a name that reports earnings and disappoints the street, and all of a sudden the stock's down 20% overnight. With ETFs, you generally don't get that. Obviously, a 20% hit to an individual name in an ETF that's a heavily weighted name is going to take that ETF down, and usually it'll take some of its peers down too, but you won't get hit as hard. And I'm generally more concerned about controlling risks than I am about how much money I'm going to make. And therefore, that's why I stick to the ETF world, at least in that particular newsletter. All right, let's take a look and shift now towards our charts. Let's see if there we go. Let's cooperate, Mr. Computer. So before we get into this, let's go and switch to the S&P. Which one do I want? Here we go. So here's a basic candle chart of the S&P 500. And these boxes that are in kind of light pink and bold green are the zones that I've told you about for weeks now that I want to do my most significant portfolio adjustments from. So whether we use 2990, which is just beneath today's low, and this is a weekly chart, so it's this week, but today being Tuesday, it's the first day of this week because of yesterday's holiday, or 30 and a quarter, which started, kind of as my main zone. Anywhere, let's say, from about today's high up through 3175 is the zone that I've said now for many weeks is the zone that I want to do some more significant selling into. because I have made the assumption, and through my analysis, and the assumption doesn't necessarily have to pan out or be correct, but the way I've kind of playing this whole coronavirus movement is that the highs that we saw in February will not be exceeded in the S&P for the balance of the year. And it's kind of a bold call because the street is filled with very confirmed bulls and very confirmed bears, and very few are kind of saying we'll be range bound. And I do think we will be range bound for the balance of the year, such that as we get up into this zone, I want to be a seller and to lighten up my longer term portfolio exposure to the market. And when and if we get back down here, kind of under 2,600, which I suspect we can do later this year, just because of the normal rotations and what I expect in the market, that'll be my buy zone. And that'll go from, I don't know, let's just call it roughly 2,600 down to about, I think we had 2,490 or so, or something right around there. And I don't think we're going to take out this year's lows, and I don't think we're going to take out this year's highs. And I've come up with that mostly because I don't think, even with the stimulus that the government is doing, that it will be enough to overcome the massive unemployment and the problems companies are going to have. I read an article yesterday about a major restaurateur in, I think it was Portland, and a guy who owns, I think it was half a dozen restaurants, who says he's not likely going to be able to open any of them in the future because of the situation, because of social distancing, because it'll be extremely difficult to judge how much to buy food for any of these restaurants, how crowded they can get, or not crowded. And, I think his plight is no different than many others. I know for myself, I can't imagine the next time I'm going to go to a movie theater. I'm not even sure next time I'd be comfortable going to a restaurant or anything in a big crowd. So the market coming back as it has not been a surprise to me. And that is why for as many weeks as I have, we were saying when we got up here, we would start adjusting our portfolio and taking some longer term stuff off the table. And I had a good friend of mine this morning send me an email saying, and he's a portfolio strategist at a boutique research firm, and he's very, very bulled up, and their firm is looking for new highs and significantly higher highs over time. And he said to me, at what point, would you turn bullish? And I wrote back, I'm not sure, but I know at this point, there's nothing, I mean, give me another 100 S&P point rally. I'm very happy to take it. The fact that I think we're range bound doesn't detract from the fact that we're still making money on our longs to the upside. And all I'm doing is saying that as we get up into the zone, I'm willing to reduce that long exposure for the chance that I'll be able to buy it back down here later this year. And what's the worst case? What's the worst thing that happens? We sell into this area and I have to put them on higher. I don't know where, let's say, that number is at this point. But the worst case is that we sell in here, which is, if you look at the relative movement from the all-time high to the low we saw in March, we're talking about being in the, we're selling in the upper quartile of relative to where the all-time highs are. So it's not so far off the all-time highs. It's not a crazy place to do selling. If I have to replace it in the future at a higher level, I do. And all I've done is given up the opportunity cost between if I'd still held them relative to where I put them on. However, I also think of things in terms of being a trader and a portfolio manager for myself. And if we get up into this zone, which we just kind of touched into today, and I do nothing, and then we do sell off and we get down, to 2,600 or beneath, and I've stared at this thing having done absolutely nothing on the decline, I think I'd be pretty annoyed with myself, kicking myself and saying, what more were you looking for? How greedy would you be, or had I have to have been, in order to keep holding this going? It's going to give me more. It's going to give me more. Yeah, maybe it does. Which one's going to hurt me more? Selling in here and having to pay higher to put them back on at some point, or doing nothing and watching all the portfolio value disappear and be close to, again, not the lows, but give back a significant amount of the last 2 months' gains. And I would say the latter will hurt me more, both psychologically, and it'll hurt. And we'll talk about this, our trader education piece in a couple minutes. But this will hurt me more, even though, yes, I would make more money. But I think the damage to your own trader psyche, and we'll talk about discipline, will hurt more to watch the market come back down having done no selling at all. So I'm not saying that I am getting out of equities altogether. I am not saying that we are going short. I am saying that I am reducing long-term exposure roughly within 10%, give or take a few percent either way, of the all-time highs. And that's not, a bad strategy to do. That's the way I look at this. So that's my take on the S&P, and it's the same thing I've been telling you for weeks. Let's take a look at, we've looked at this also, gold stocks, right? This is the GDX. And you look at this, a weekly chart going back here. We start this kind of resistance area right near $32 in 2013. And we get there again in 2016. And we get pretty darn close to that in 2019. And we get there early this year. And then the gold stocks sold off into the coronavirus decline of all assets, and then comes screaming back and breaks out. And obviously we're not near all-time highs. Those are way up here from 2011, but we have broken out above all these tops. So we had a 6-year rounded bottom, maybe almost a 7-year, and then we come out to the top side. We hit targets, which were propulsion targets that we've had from before. So we said we are long this and in the no trader. Last week I had, I think this can go much higher over time, but it's not crazy to take some off the table because we've hit the initial targets. But I think this is something that you want to be a buyer on pullbacks in gold names, because it would be unlikely that this would have a breakout like this and then come anywhere significantly back into the range. It doesn't necessarily have to hold somewhere near that $32 level, but I would say, it's real good odds that this thing's not getting under 29 and change. And therefore, I think if gold stocks move anything like gold has since it broke out of its 6-year rounding bottom back a year ago, then this has a big move to come on the upside. So that's what I think of gold stocks. Nothing's really changed on the Treasury side. US 10-year still sitting in its range, so no reason to really take a look at that. So what I do want to do is now switch to our little education segment, and that is about taking losses. And to me, any good trader needs to and knows that taking losses is part of the game, and it's essential to be able to do. In very simple terms, it's okay to take a loss. And you should, with some frequency, when your trade isn't working out the way you thought it would. So, before you put a trade on, what I'll call like your pre-trade preparation, it includes setting realistic price targets, and we've talked about that before, setting stops that are within, at a level such that if you get to your stop level, it tells you that what you thought was going to happen isn't happening. And I'm always a proponent of using stops and sticking to my stops, because it's about discipline. And if you hold on beyond where you've set your stop at, and you don't get out when you've hit your stop, you're actually showing yourself that you lack discipline. And I can't tell you how detrimental that is as a trader, to know that you don't have discipline. In fact, if you know that about yourself, if, let me think of an example. Well, oh, here's one that people deal with all the time: dieting. We say we're going to diet, and for 3 days we're great, and then all of a sudden we're chowing down, huge calories and 2 banana split ice cream sundaes. Um, so you know that you don't really have the discipline, and therefore it's often time to get help from the outside when you can't do it yourself. In the case of trading, if you know you're the type person who lacks discipline and you show it to yourself both in your life and in your trading, then you shouldn't be trading, because you're going to lose money over time, and you'll lose it consistently. The number one trait of all successful traders, and these are some of the best traders in the world who've been interviewed, go back to even like Jack Schwager's books from the 1980s on, what were they, Trading Wizards, I think was the name of the book, and it came out with a few editions over time. They will all tell you that the number one characteristic to have as a trader is discipline. And discipline includes being able to take losses, and readily take losses, without it tearing you apart. A lot of people don't take losses. Their fear of, they have, let's say, a fear of locking in a loss. They have a fear of, their head says, oh, if I sell out now, I'm going to sell the low. They have a fear of probably looking bad to other people, that they're taking losses. They have a fear of being wrong. Taking a loss means you're wrong. You have to admit to yourself that what you thought was going to happen isn't happening, and that your analysis was wrong. And it doesn't matter if the reason you're wrong is because of some outside event like coronavirus that plunks stocks, or just your analysis was wrong. Though it doesn't matter why. If you do your pre-trade homework, you have a target, and I'm assuming, let's say you're long stocks here for this conversation, and you have a sell stop in place. When you get to the sell stop, that your analysis will come back, that the stock will come back, that, oh, well, this stop level, it'll just stay here for 5 minutes and then we'll come back. Look, nobody likes to take losses, but it's just part of the game. And you really have to understand that and accept it. Because the most important thing for you to have is discipline and the belief in yourself that you're going to do what you set out to do. Kind of like that, your words are your word. Meaning that if I say I'm going to do something, I actually do it. So if I say I'm going to buy stock at 30 with a target of 38, but if it gets to 26, I'm out. If it gets to 26, you have to get out. You don't hem and haw. You don't say, because if you don't get out, there's a real good chance that you're going to lose even more money. And then your brain says, okay, well, this really wasn't a trade anyway, so let's put this into the investment camp. We'll hold this long term. I used to do that. I rarely do it now. I can't say that I've never, in the last couple of years, done it, but I do it a heck of a lot less, because I have a ton more discipline than I used to have from 20 years ago and 30 years ago and 40 years ago when I first started in this business. And now when I put something on, I know where I'm going to get out. And even in the case of where I showed you earlier, the S&P, and I told you about my friend saying, at what point will you get bullish? I kind of have a sense in my head. I wasn't sharing it with him, but there are multiple conditions that would have to occur for me to actually get bullish, rather than, look, I'm going to sell into the strength anyway. The question is, where do I replace what I'm selling? Am I going to be able to replace those sales lower, which is what my goal is, or to replace them higher? But if I replace them higher, then I say, okay, my analysis was wrong. I've given up some opportunity cost here where I could have made more money than I did. It's not a loss per se. It's just making less money than I could have. And that's that. And I readily accept it as, okay, it didn't work out. And I move on, and then I just observe and make my next choices of how to make money and what to do next. So we're going to turn now to looking at those transport names, but it's really important that if you're going to trade the market, you believe in yourself, you trust yourself, and that you have a written down game plan with actual orders in. More important than the target orders are the sell stop orders on your longs. And so when you put in a stock, you buy a stock, you have to know where you're wrong before you put it on, and you put your orders in and keep them there. And that's what is going to save you money over time. Okay, let's take a look at some transportation stocks. We'll try to get to as many as we can in the time we have left. So here's NSC, Norfolk Southern Railroad, and the railroads make up a large portion of the transportation index. And this is a weekly chart going back a few years. And one of the things I noticed here, besides the fact that a bunch of different 13s were fairly good at calling some near-term pullbacks and some, larger ones, including having an upside exhaustion signal just before, looks like 2-3 weeks before the all-time high was put in here. Notice that this has somewhat of that similar pattern to the S&P, higher highs and lower lows. And again, to me, this year's price action, and we'll have to look at other charts in the few minutes we have left to see if they're similar, but this year's price action, whether it's in this particular name or the S&P, is called an expanding pattern, and it's often the left half of a diamond pattern. So it would be fairly atypical for this to keep coming and go make new all-time highs without some type of high put in place that's lower than the all-time highs, and then a decline that's higher than these lows. So the flip side of this pattern becomes lower highs and higher lows over almost often the same amount of time it took to make this pattern. So if the March decline, the February March decline was the midpoint, then there's no reason to think in the next year that this stock goes and makes new highs. So I'm glad to see that the low a couple weeks ago was where the bearish propulsion level was at 158, because it rejected that, and now it's actually got a minor bullish play. And if we got up to 195-ish, where the propulsion 195 to 205, I'd be a very happy seller there, looking for a further decline. Union Pacific, UNP. Okay, come on, here we go. Same thing, kind of higher highs, lower lows, very similar look. You're on an 8 count. That means, and I have a propulsion target of 172 and change. We're at 170. To me, if I had this name, I'm probably reducing exposure right up into here. Let's get away from a railroad. Let's try FedEx. Totally different chart, right? Not near its highs. It's a very weak chart. You low in March, but this has not recovered a heck of a lot, and you should have a wall of resistance from this whole section here in 2019 ahead. So if there's some resistance right here, and then again kind of in the 148 to 150 level, or 146 to 150, those are my upside targets. Clearly not a great name, and it's going to have a much more difficult time over oh, that's my little signal that we're just about out of time. Let me try to get to, let's do something that's, let's find a truck or let me see, what else can I find? Let's do a little different, but JB Hunt. And we'll finish up with this. I'm sorry I didn't get to all these names, but we talked about a lot of other important things. 9 counts pretty good, 9 bottom here. 9 bottom this year. This is doing well. I'd say if you believe in the same thing, that new highs shouldn't come, then anything near 124, 125 would be your exit. And as long as it's above 100, I'd say it's good. That's it for this week. Thank you for listening. I'm Rick Bensignor, and this has been In the Know Trader.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.